What if China is already preparing for a world where your dollars mean nothing? No announcement, no warning, just a quiet, calculated retreat from the very system that built the modern economy. And it all started when the West made one fatal mistake. 2 years ago, the United States and its allies froze hundreds of billions of dollars in Russian foreign reserves, money that was supposed to be untouchable, money stored in Western banks for safety. Overnight, it became a weapon, and now that money is being carved up to fund Ukraine. For Russia, it was punishment, but for the rest of the world watching, it was something else entirely. It was a warning: if you hold assets in dollars, they belong to you only until politics decides otherwise. Beijing did not miss this. China holds one of the largest stockpiles of American assets on the planet. For decades, these were considered safe, liquid, untouchable. But after what happened to Russia, those assets suddenly look like a trap. A lever that could be pulled the moment tensions over Taiwan, technology, or trade reach a boiling point. Here's what no one is talking about. China is not making dramatic moves. There are no press conferences, no fiery statements, no panic selling. The shift is silent. It is slow. It is buried deep inside balance sheets and quarterly reports. They are letting bonds mature without reinvesting. They are buying less new American debt. They are stockpiling gold. They are settling trade deals in yuan instead of dollars. These are not emotional reactions. These are calculated long-term strategic decisions, and this is where things get dangerous. When a country like China starts preparing for a world where the dollar is no longer fully trusted, the consequences ripple everywhere: global trade, energy markets, interest rates, your mortgage, and your retirement savings. The dollar is not just a currency, it is the backbone of modern finance. If that backbone starts to weaken, even slowly, the shockwaves will be felt in every economy on Earth, including yours. You might hear analysts say China cannot dump the dollar because it would hurt them too. That is true. A fast sell-off would destroy the value of their own holdings. But here is what most people miss. They do not need to dump it fast. They just need to stop believing in it the way they used to. Slowly reducing exposure, quietly building alternatives, letting time do the work. In death by 1,000 cuts, not a single blow. And China is not alone. More countries are signing non-dollar trade agreements. Central banks around the world are buying gold at record levels. Even traditional American allies are quietly exploring ways to reduce their dependence on the dollar, not out of rebellion, out of self-preservation. So the real question is not whether China is selling off dollar assets overnight. The real question is this: why do they no longer trust the system that made them rich? And if one of the biggest players in the global financial game is already planning for a post-dollar world, what do they see coming that most people refuse to acknowledge? China did not accumulate over $1 trillion in American treasuries by accident. It was the natural result of its export-driven rise. For decades, China sold massive volumes of goods to American consumers. Those sales were paid in dollars. And instead of letting that money sit idle, China's central bank converted it into United States government bonds. By buying dollars and investing them abroad, it kept the yuan weaker, making Chinese exports cheaper and more competitive globally. It supported factories, it protected jobs, it fueled long-term industrial growth. At its peak, China became the largest foreign holder of American debt. That level of investment symbolized how deeply China had tied itself into the dollar system. But over time, something changed. Month after month, year after year, the holdings started falling, not in a dramatic crash, but in a controlled, consistent pattern. This was not random market behavior. This was a strategic shift, a deliberate repositioning. This shift has a name: de-dollarization. It means reducing reliance on the United States dollar as the main reserve in settlement currency. China started diversifying into gold. It increased currency swaps with other nations. It began settling more trade in yuan. It built alternative payment systems to reduce dependence on Western financial networks. This was not a sudden rejection of the dollar. It was a gradual adjustment driven by risk awareness, geopolitical tension, and a long-term plan to make China less vulnerable to external financial pressure. Over the past decade, the United States has increasingly weaponized the dollar through sanctions, asset freezes, and access restrictions to financial systems. Washington has shown that control over the global reserve currency also means control over who can participate in global finance. For countries that depend heavily on the dollar, this creates a terrifying new vulnerability. Your reserves are no longer just savings. They become leverage that can be used against you the moment political conflict erupts. This fear exploded when Russian foreign reserves held in Western institutions were frozen and redirected toward Ukraine. Those reserves were supposed to be protected by international financial norms. Instead, they became instruments of punishment. For Beijing, the message was deafening. Not spoken, but impossible to ignore. If a major power like Russia could lose access to its own money overnight, then no country is immune, especially one locked in strategic rivalry with the United States. At the same time, economic pressure mounted. As the United States interest rates rose sharply, bond prices fell. This reduced the market value of existing treasury bonds, including those held by China. On paper, these assets lost significant value, creating hidden financial strain. Holding too much in long-term dollar bonds began to look less like safety and more like exposure. So China started reshaping its reserve strategy. It expanded gold purchases, building physical reserves that cannot be frozen by any foreign government. It increased investments in non-dollar assets, including bonds from other economies and commodities. It strengthened regional trade settlements using its own currency. It created bilateral currency swap agreements to bypass the dollar entirely. This shift is not driven by panic. It is calculated risk management, reducing exposure without triggering shock, diversifying without disrupting markets, preparing for multiple futures instead of trusting one system. China's approach to reducing its exposure is deliberate and quiet. Instead of suddenly selling large volumes of treasuries and shaking global markets, it has taken a subtle route. Many of its bonds are simply allowed to mature. When a bond reaches its expiry date, the United States pays back the principal. China then chooses not to reinvest the money into new treasuries. This method lowers exposure without triggering panic or crashing prices. On the surface, it looks calm, but over time, it steadily shrinks China's dollar holdings. There is a reason China cannot simply dump its dollar assets, even if it wanted to. A rapid sell-off of United States treasuries would collapse bond prices. That would instantly destroy the value of the very same assets China is trying to move away from. It would be financial self-destruction on a massive scale. The losses would not be theoretical. They would be real, immediate, and devastating. That is why any shift has to be gradual, almost invisible, spread over years, not weeks. There's also the currency problem. If China sells large amounts of dollars, it would naturally increase demand for the yuan. A stronger yuan makes Chinese exports more expensive for foreign buyers. This directly threatens the core of China's economic model, which depends on competitive exports. Factories, jobs, and growth all rely on maintaining a careful balance in currency value. Too much appreciation would cripple its global position. This is why China's strategy appears slow and controlled. It is not about sending a message. It is about protecting itself during a long transition, reducing risk without creating new ones, pulling back without tipping over the entire system. But the effects do not stop at China. If major holders continue reducing their treasury exposure, it changes pressure on the United States bond market. Fewer buyers means lower demand pushes yields higher. Higher yields increase United States borrowing costs. Those costs ripple across global interest rates. Mortgages become more expensive. Corporate loans become more expensive. Government debt worldwide becomes harder to service. Emerging markets feel extra pressure as capital shifts back into higher yielding American assets. This also reshapes trust in global finance. When the biggest players quietly step back, others notice. Smaller economies and central banks may follow, not out of ideology, but out of caution. This creates a slow rebalancing of global liquidity, where the dollar remains powerful but is no longer unchallenged. China is not moving alone. Around the world, other countries are quietly adjusting their financial posture. Some are reducing the share of dollars in their foreign reserves. Others are settling trade in local currencies instead of the United States dollar. This does not mean the dollar is disappearing, but it signals a gradual shift in how countries manage risk. Nations that once depended heavily on the dollar system are now seeking more balance, more flexibility, and more control over their own financial channels. Central banks have been increasing their gold reserves at levels not seen in decades. Gold is physical. It cannot be frozen by foreign governments. It does not depend on digital payment networks controlled by any single power. Alongside gold, regional currency systems are expanding. More trade between large economies is being settled in their own currencies, reducing the need to convert through the dollar. New payment platforms and clearing systems are being built to support this change. This is where finance turns into geopolitics. Currency is no longer just a medium of exchange. It is influence. It decides who has access to capital, who can be isolated, and who can survive sanctions. When countries reduce dependence on one currency, they are not only making an economic choice, they are making a strategic one. They are reshaping power relationships, gradually moving from a single center of gravity to a more fragmented global financial order. So we return to the central question. Is China's move away from dollar assets a panic reaction, or is it a signal that the rules have changed? A signal that financial safety is no longer guaranteed by tradition. A signal that power is shifting from loud declarations to quiet preparation. If China keeps reducing its exposure and others follow, dollar dominance does not collapse overnight, but it begins to thin. Influence spreads. Alternatives grow stronger. The dollar remains powerful, but it faces real competition for the first time in decades. A world with multiple financial centers starts to take shape. If China moves carefully, step by step, it could reduce its risk without breaking the system that still supports global trade. A slow unwind, a controlled transition, no shock, no chaos, just a gradual rebalancing that most people only notice when it is already far advanced. But history shows that big shifts rarely announce themselves early. They happen in the background, in data, in policy changes, in small decisions that look insignificant until they connect into something much bigger. And now the forward question matters more than anything else. Are we heading toward deeper de-dollarization, an even stronger rush into gold, or the birth of an entirely new reserve system that rewrites how global money works? That future is still being shaped, and the decisions being made right now in silence will determine what your savings, your investments, and your financial security look like in the years ahead. This is not just about currency. This is about control. This is about trust. And this is about what happens when trust disappears. If you want to understand these global power shifts before they hit the headlines, subscribe to America True Desk now.